Hello again, everyone. This is Kevin Hissong with Rain Over Money. Welcome to episode 17. And today we're going to be talking about an investment strategy called dollar cost averaging, or DCA, as it is known in short. So we're going to jump right into it. It's not a complicated strategy. It's something many of you are already doing, but it's one of those things that if you understand it, it can really help your mentality when it comes to investing, especially through the hard times. And, right now markets are kind of flat, not doing a whole lot. And obviously we're coming off the last year or so. So this is something to keep in mind, not only for where we're at now, but where we're going in the future, that can really be a positive to help you reach your financial goals, short-term, mid-term, long-term. It can come in handy for all types of strategies and situations. So dollar cost averaging. Again, my name is Kevin Hissong. Welcome to Rain Over Money, episode 17, dollar cost averaging. Give us a like if you're looking at YouTube, listening through the podcast. Visit us at Twitter, Instagram, so on and so forth. All right, jumping into it here. Dollar cost averaging. This is my favorite, if not pretty much my only investment strategy that I've ever used. I like it so much that about 20 years ago now, I wrote an article. It was I just kind of on a whim said, you know what, I want to see if I can get an article published. And about 20 years ago, we were coming off the dot-com bubble. The NASDAQ was falling apart. All the internet companies were going bust and so on and so forth. And it was really the first real bad investment period we had in quite a long time, because there was quite a good bull market through the 90s and late 90s, early 2000s, somewhere in that time frame. We caught into a rut, and that's when, to me, dollar cost averaging was so important, and a term that's been around a long time. I don't know who invented the term dollar cost averaging, but whoever did it, nice job. And so I wrote this article, and it got picked up by two different outlets, Young Money Magazine and Military Magazine. Kind of random, but yeah, it was dollar cost averaging. I think the subtitle was something like, "You couldn't have picked a better time to be young in investing." And that's really something I think that's stayed. It's not that you just need to be young and investing. It's anyone that is able to do a consistent investing pattern over time. Dollar cost averaging can really help you through the ups and downs, and I'm going to explain why that is. So what is dollar cost averaging? Dollar cost averaging is a periodic, planned investment strategy where you're constantly putting money to work. I want you to think, if you're familiar with your 401k or your retirement plan, even if you're not using one, how they work is you get a paycheck, and each time you get a paycheck, a certain portion of that money that you've designated is coming out of that paycheck and then being invested into your retirement plan. So whether you're getting paid twice a month, weekly, once a month, whatever it is, you are constantly investing in the market. And, if you look back throughout a year, let's say in January and February, you invested when the markets were doing really well, and then the markets fell apart over the next 4 months. So over March, April, May, June, you invested at much lower amounts in the different investments, because obviously the investments are fluctuating every day. So sometimes you're going to be investing when it's higher, sometimes you're going to be investing when it's lower. If you're buying, whether it's shares or units or whatever it is, of ETFs or mutual funds and stocks, sometime you're going to buy 5 or 6 shares or 5 or 6 units. And other times, if the price has fallen, you are putting away enough money to buy 8 or 9 shares. So you're buying more. So that's one of the benefits. I think you can probably see where I'm going here, is when the markets do hit a down cycle, and whether it's short-term or long-term down cycle, you take advantage of that as an investor by being able to gobble up more shares. And there's one place you definitely want to be greedy, and that's in investing, in terms of you want all the shares. You want as many shares, as many units as possible of the different investments you can have. So anytime you get a chance to buy 8 or 9 instead of 6 or 7, that's great. Now, your overall account value may be down, but as we've discussed, think about, short term, you're going to have these blips up and down, whatever it may be. But if you pull out a S&P 500 chart over the long term, 30, 40, 50 years, it looks like you're climbing up a mountain. Yeah, sure. There's some valleys you have to go down in between that, but when you expand it out, and the longer you expand it out, the overall tendency is the market is going to go up. And that's why dollar cost averaging is so important, because you're constantly putting money in. It doesn't matter how the market's performing. If it's performing up, great, your overall account value is up. If it's come down a little bit, great, you're going to buy more shares, and those shares then should outperform over time, and you've got more shares that are accumulating better. Because think about it. If let's just use one specific company. Let's say a share price of a stock is $100 a share, and you buy 5 shares, and that's $500 total, and it accumulates over time, and say that stock price doubles over a couple years. Now you've got $1,000. That's great. But what if that share price was down around $75, $80? You still had that same $500. You're going to buy many more shares, and those shares doubling over time are going to be able only to increase that much more. So it's I don't know, maybe I'm oversimplifying it, but if you can invest over time and not worry about the short term of what that price is doing, as long as you're investing in good quality companies, good quality indexes. That's why the S&P 500 is one of my top holdings. I'm not going to try and beat the markets. I'm going to let the S&P 500 do what it does over time, as it always has, and I'm going to reap the benefits down the road. At least I believe that. And like I said, 3 out of 4 years, it's going to be up. And over the long term, it's returned, around 8% over the last 40, 50 years or so. So great option to choose if you're starting to set a fundamental base for your investment portfolio. So with your 401k, with your whatever your paycheck's going into, you're investing over time, you're buying low, you're buying high. It's great because it takes the psychological part of investing out of the mix. People get so scared sometimes, obviously with the pandemic. A lot of people were scared. A lot of people left the markets. A lot of those people left the markets and never come back. And, the markets have done if you look at the beginning of the pandemic till now, the markets have done, pretty darn well. But so many people have not come back. So many people are sticking their money in earning 3 or 4% in CDs, thinking that's a great rate. But when you look at inflation, you're not even keeping up with inflation. Inflation is coming down, we know. And it's okay to put some money in a short-term place where interest rates, you can take advantage of those CD rates and money market rates and so on and so forth. But the majority of your money you want growing over time and trying to keep up with the market as much as possible and based on as much risk as you can tolerate. So again, going back to the psychological behavior of it, you don't have to worry if the market's up. You don't have to worry if the market's down. It's an automatic investment strategy, and you're dollar cost averaging in, which means you're buying high, you're buying low, you're buying medium over the long term. That is dollar cost averaging in a nutshell. Nothing special there whatsoever. So that's the term. That's what you're doing primarily in your 401k. So as I mentioned, as you get more disposable income, maybe you've got your 401k, maybe you're looking at setting up a Roth, maybe you're looking at setting up a joint brokerage account, you should try and do the same thing, because dollar cost averaging and some type of systematic investment plan go hand in hand, because you want to be buying regardless of what the market's doing and not trying to time things. There's a great saying, and if you've been around the financial industry at all, you've heard the saying 8 gazillion times. It's time in the market, not timing the market. Time in the market, not timing the market. And I thought I could go through my entire career of Reign Over Money and not say that, because it's been beat to death, but it's so true. It's one of the great sayings of all time. When what that means is it's time in the market. You've got to stay invested and don't try and pick when to invest. One of the greatest stories I ever heard, Peter Lynch was a famed Fidelity fund manager and managed the Fidelity Magellan Fund for many years. I want to say in the 80s, 90s, maybe he left in early 2000, maybe in the late 90s. But he was known because the Magellan Fund had outperformed the S&P for many, many years. And he was like the greatest fund manager, and everybody wanted to put their money in the Fidelity Magellan Fund. And I think it had so much money in it, it eventually closed to new money. But that being said, they ran a study, and it showed that people that were invested in the Fidelity Magellan Fund only got about, I'm going to mess this up, I'm sure. But the Fidelity Magellan Fund, let's say if the S&P returned 8 or 9%, it returned 12% a year for 20 years, something like that. People that were actually invested in the Magellan Fund only got about 4% returns. So why, if the fund did 12%, did they only get 4%? It's because individuals were putting their money in and taking their money out and moving it around and putting it in the contra fund and putting it in money markets and trying to time the market instead of just keeping time in the market. So that's a perfect example, and that's one that's always stuck with me of you had this great fund manager who was just crushing the market for many years, which is so tough to do. And many people actually didn't reap the benefits of it because they thought that they were smarter than Peter Lynch and wanted to move their money in and out. So stay in the long term. If the market, if your portfolio is reacting too much and you don't like how it's returning, in other words, you're not happy with, and it makes you feel uneasy, maybe how much you're losing in a down cycle, you've probably got too much risk in the portfolio. You want to stay invested, but maybe, go in a more conservative or moderate route if you're invested aggressively or moderately aggressively. Pull back your investment strategy a little bit. Maybe put some in bonds, put some in money market, don't have so much exposure in equities and stock portfolios and so on and so forth. So again, like your 401k, like your 403b, your TSA, whatever it is, your 457 plan with the government, putting money in on a constant basis takes that behavioral out of it. You just know that, hey, I'm winning by putting money in every 2 weeks or every month or every quarter, whatever it is. So if you're setting up your Roth IRA, try and do the same thing. A lot of people, I think, some people, I don't know the percentage, some people will put in their lump sum, whether it's the 5,000 or 6,000 they can put into their Roth IRA. They'll put a lump sum in and invest that right away. And every year they'll do the same thing. Maybe it's at the end of the year or right before tax time, they'll do that. And really, that's one method of dollar cost averaging. Dollar cost averaging doesn't say dollar cost averaging means, there's no rules that say it has to be a weekly investment or a monthly investment. If you're doing the same thing consistently, even if it's on an annual basis, there's enough movement over time that even dollar cost averaging on an annual basis can work. But maybe you're setting it up so that, hey, I'm going to draw monthly from my account and put it into my Roth IRA, or I'm setting up a joint brokerage account. You pick your investments, excuse me, that you're going to choose, and let that automatically go into those investments. Now, a joint brokerage account may be a little more difficult because you may not always be allowed to set up a systematic investment into the specific investments. What I mean by that is the money first has to move from your bank account to the joint brokerage cash holding account. And from the cash holding account in the joint brokerage account is where you make your purchases from. So a lot of the times, if you're setting up a systematic withdrawal from your bank account into your joint brokerage account, that money is going to sit in your cash account in the joint brokerage until you decide what ETF, what stock you want to invest in. Depending on who you work with, if it's E-Trade, Robinhood, so on and so forth, you may be able to automatically set up buying shares systematically over a monthly or quarterly setup. And if you can, that's great. I would highly recommend doing that, because if not, you have to manually decide each month or each quarter to make those purchases. So the more you can automate, the better. The more you can get it out of your hands and not even see it, the better. So just a couple ideas there. And then the last thing I'll say about dollar cost averaging and why I love it is because it ties in perfectly with dividends. Now, in your 401k, unless you've got some solo 401k that you've set up that you're buying your own investments, many 401k options will not throw off dividends. But if you've got a Roth that maybe you've got individual stocks in, or you've got some ETFs or mutual funds that pay dividends, and the same thing with your brokerage account, if you've got stocks, ETFs, anything that throws off dividends, is dividends are kind of a default dollar cost averaging. We've talked about AT&T in the past. AT&T is paying a ridiculous dividend right now, around 7%, although the stock isn't really doing a whole lot, so I don't know how great of a growth stock it is, but you can't beat it when it comes to dividends it's paying. So it's paying like a 7% dividend right now. So you've got $1,000 you invest in it. Every year that's going to throw off about $70 of dividends. That's going to repurchase more shares. And most of the time, stocks, ETFs will pay on a quarterly basis. Sometimes they'll pay on a monthly basis. But when you reinvest those dividends, and remember I've said before, it's called a DRIP, dividend reinvestment plan. You do need to check a box or do something with your brokerage account or with your Roth to show that you want those dividends reinvested. Otherwise, they're going to be paid out and sit in that cash account of your Roth or of your brokerage account. But if you check the box, you get the dividend reinvestment, those dividends are automatically going to reinvest. So AT&T, perfect example, they pay a quarterly dividend. I think the last one was in April. So the April payment goes, you get your dividend, that money automatically goes in and buys shares at the current price. And again, that's dollar cost averaging. It's buying it at the current price. So it buys in April, it buys in August or whatever, it buys in October. So no matter what AT&T stock is doing, you're buying each time. And if it's up, hey, maybe you're buying less shares because the stock's up, but hey, your overall stock account is growing. If it's down, you're buying more shares. Great, because when it does turn around and go up, eventually you're going to have more shares and reap the benefits because more shares equal more money in the long term because we want all the shares. So that's why I think dividends play a nice role in this. You don't need all your investments to pay dividends, but it is nice while you're in this accumulation phase, because we'll talk about the income phase when you're ready to retire, how to get money shortly in an upcoming episode. But as long as you're in this accumulation phase, you want to accumulate as many shares and as many units of ETFs, mutual funds, and stocks you can. And dollar cost averaging and reinvesting dividends is a perfect 1-2 punch to be able to do that. So that's all I wanted to say about it today. I hope that gives you at least an idea. If you see just the term DCA, Dave, Clark, Adam, DCA, or dollar cost averaging, that's a term. It's a powerful term. It's a simple term that you can utilize, and you're probably already utilizing it in the market. So next time the markets go way down, just think of it as, oh, this is perfect opportunity. Once you get over being upset and fearful that the world is coming to an end, think about, hey, this is a perfect opportunity because the next time I invest, I'm going to be buying this many more shares, and I'm just going to be ready for when the markets take off again. So hopefully that helps your psychology when it comes to investing a little bit. It can be difficult, but investment behavior is one of the things that you have to power through and kind of harden yourself at a little bit to be prepared to go through all the bumps of investing, especially if you're investing in the stock market. You do that, it's going to pay off over the long term. Again, so I'm Kevin Hissong. Thanks again for taking this time to join me today, Reign Over Money. Feel free to visit the website, ReignOverMoney.com, Instagram, Twitter, Reign Over Money handle on those accounts. And got a comment, got a question, hit me with an email. So thanks again, everyone. Hope you enjoyed this episode of Dollar Cost Averaging. I'm Kevin Hissong with Reign Over Money. We'll see you next time. Have a great one.